Joining us here at Post 9 is John Stoltzfus, Oppenheimer Asset Management Chief Investment Strategist. He's got an S&P target of 5,900, so not a whole lot of room for upside from here. But are you going to raise it once we reach that?
Well, Sarah, great to be on the show, first of all. But I've got to say, our target, we have a discipline, and we have to see our target close at or either at or above, the market close at or above our target before we consider raising it. So, we came in this year, last December, we put in a 5,200 target. In March, we had to raise it, and we raised it to 5,500. By July, we raised it to 59, but we'll have to wait. That's just our discipline.
So you've increasingly raised it as the market has climbed higher because you underestimated what?
Well, I think what we underestimated, if anything, was that the Fed would remain as successful as it has been, even though we're big fans of the Federal Reserve. We think this cycle, they've been remarkably sensitive in the way they've applied their dual mandate. And then, of course, the business has been remarkably resilient, and the consumer in particular, even as rates have remained high, with the exception of the 50 basis point cut in September, the consumer remains remarkably resilient. So all of that. But what you've got to remember, too, that when we came in with a 5,200, I think we were tied with someone else for the highest on the street.
I remember that.
When we went to 5,500, we were the highest on the street. 5,900, we were highest. And we get stuck. We may, if anything, what we don't want to do for our clients is tell them, okay, we're going up. Oh, no, we're going to go down. If you remember, in 2022, a lot of our peers were going, first they raise their target, then they'd lower it and back and forth. We don't want to jerk them around. And as a result of that, we find our clients have been remarkably calm in pullbacks, because they see, knocking on wood, we have been remarkably good at our calls. As you know, sir, we know John since 2012, when I've been bullish since 2012. When I came
You've been more right, but if anything, you've been not bullish enough.
Yeah, well, I've been conservative. Let's put it that way. Conservative businessman from New York.
To the conversation that Steve and Sarah were just having, the Amex CFO today, Fed rate cut is too small and too early to see any impact in terms of spend patterns. When do you, or if do you think that'll actually come about?
I think the Fed is pretty well stated that it's committed to ending this Fed funds hike cycle, but it also wants to be very careful so that Powell doesn't experience an Arthur Burns kind of situation. At the same time, he doesn't want to do like Alan Greenspan occasionally had, where he'd push the economy into a recession or near recession. So there's a balance here. Our take on it is, we want to see the non-farm payroll number that's coming up for the October, because it will reflect what happened in Georgia, what happened in Florida, Tennessee, and in North Carolina. Remember when the big disappointment non-farm payroll came in, it was the July number, as I recall, when it was reported the 1st of August. The market went, oh, my gosh, what's going on? And a lot of that was Houston. I was in Houston just a few days after.
That was Beryl.
And that was, Houston, there were millions of people without electricity. Businesses didn't have electricity. So how could they even attempt to do the surveys with the Fed there?
Right.
And so let's see what happens. And I think the Fed could easily cut a quarter at 25 bips, either in November or December. It'll do it as needed, if needed. So we remain calm about it.
You're feeling good.
Feeling good.